The Great Depression in 1920, or excuse me, the Great Crash of 1929, most people think actually caused the Great Depression. While it was something that led to the Great Depression, it wasn't the primary cause of it. So some of the things that led up to this event, you had a small number of companies and families who held much of the nation's wealth, and a lot of farmers and your workers were suffering at that particular time. Individuals were buying a lot of consumer goods, and they were buying these on credit. Industries were producing far more goods than consumers can buy, which eventually creates a surplus. And when you have a surplus of goods in a market, it's going to cause the price of those goods to fall. Another thing you had is speculation or speculators. And speculation is the practice of making high-risk investments with borrowed money in hopes of getting a bigger return. So people were going out and actually borrowing money to put in the stock market. They could not afford to lose this money because obviously if you borrow it, you have to pay it back. Buying on margin was another thing, and this is very, very similar to just going out and getting a bank loan. But what they could do is go to their investor and they could purchase stocks for only a fraction of its price, and then they would borrow the rest from the brokerage firm itself. And what a brokerage firm can then do is what's called a margin call, where if the value of your stock starts to fall below a certain amount, they can call you and ask you to put more money in your account, or even potentially sell your stock and give your money back, get their money back. Speculators were absolutely devastated by the crash. Many of them had borrowed up to 90% of the value of the stock. So if you're anticipating the stock to go up so that you can sell the stock and actually make money and pay back your loan, if the value of the stock drops below what you purchase it for, you know, you're losing all of that money, plus now you have to pay back the bank or you have to pay back the brokerage firm at the margin call. So the crash itself, September 1929, the Dow Jones was at an all-time high, which is kind of interesting because that was 381 points at that particular time. You know, today it's trading at, you know, around 16,300. But at that time, most of the stocks were trading far above their real value based on the company's earnings and assets. So the stock price relative to what these companies were actually making and the assets they had on hand, very much overpriced. October 23rd, you have fear. October 24th, everyone starts panicking. Everyone starts selling. Then we get to October 29th, 1929. It's called Black Friday. At that point, there were a record 16.4 million shares sold on that particular day. So the aftermath of the crash is definitely one of the factors that leads to the Great Depression. During this period of time, we get massive unemployment, 25%, which compared to what we recently went through in 2008 with a lot of people calling it a depression or the next Great Depression, it really only got to around 10 or 11%. People lost their homes, people were losing everything, but a lot of people were building shacks out of any material that they could find and forming these shabby villages, and they called them Hoovervilles, named after Herbert Hoover, who was the president at that particular time, who really felt that the government should stay out of the economy. And then the newly formed Federal Reserve, which was formed in 1913, decided at that time to limit the money supply. They knew there was a problem with all these speculators, so they thought they should decrease the money supply, which absolutely makes things worse because people can't get their hands on money, they can't go out and buy anything. So attitudes towards stocks after the Great Depression, it really was as late as the 1980s where people started buying stocks. So few households held stock up to that particular time. The other thing that helped change attitudes towards investing was this idea of mutual funds, and we'll look more at that later. October 18, 1987, we get what's called Black Monday. The Dow loses 22.6%, which is actually double what was lost on Black Tuesday in 1929. But the next 2 days, it bounced back. And then another thing, the Fed did step in, and instead of reducing the money supply, they increased the money supply, trying to stimulate the economy. Stock market today, in 2007, the Dow reached a new peak of 14,000 before the crash of 2008, where it dropped to 11,500 over a very, very short amount of time. But like I said before, today it's trading around 16,300, and you just never know what it's going to do.